Welcome to today's deep dive. So most people think sports marketing is just, ads and sponsorships.
Right, the classic rent-a-celebrity model.
Exactly. But the real game happening right now is completely different. We're unpacking this massive shift where athletes are ditching guaranteed cash endorsements and, well, demanding equity instead.
Yeah, it's a fundamental change in how they view their own value.
Right. And we're pulling from PwC industry outlooks, some financial advisory guides, and academic papers on the athlete equity model to really uncover why elite athletes are essentially becoming venture capitalists.
And I mean, what that strategy can teach you, the listener, about wealth creation.
So to really grasp this, think about renting an apartment. You can paint the walls, hang some nice art, but at the end of the day...
You're still paying someone else's mortgage.
Exactly. When you move out, you take zero equity with you. And for over a century, that is exactly how brands treated athletes. They just, rented their popularity.
Yeah, I mean, that traditional model goes all the way back to 1905 when Honus Wagner let a company stamp his signature on baseball bats for just a flat fee.
Oh, wow, 1905.
Yeah, he was essentially a billboard. But modern athletes, they want to be the builders. They've realized that guaranteed cash creates income, sure, but owning a piece of the company creates lasting generational wealth.
The math on that shift is, well, it's staggering. Take David Wright. Instead of just taking a flat fee to hold a bottle of vitamin water, he negotiated a 0.5% equity stake.
A tiny sliver.
Right, a tiny sliver. But when Coca-Cola bought the brand, that turned into a $20 million payout.
Which is insane.
And Kobe Bryant used a really similar playbook with body armor. He made a $6 million investment that eventually became worth around $400 million for his family after Coca-Cola acquired them.
But diving into those financial advisory guides, it's actually not just the final payout driving this. There's a specific tax engine making this incredibly lucrative.
Okay, yeah, the academic papers make this part sound incredibly dense.
They really do. It involves a mechanism known as the Section 83B tax election.
Let's break that down, because how does that actually work in practice?
Okay, so normally if a startup gives you equity in exchange for an endorsement, the IRS taxes that as ordinary income at the highest rates as soon as those shares officially vest.
Right, which takes a huge bite out of it.
Exactly. But with an 83B election, an athlete chooses to pay taxes up front based on the startup's current extremely low valuation.
Wait, so they pay a tiny tax bill today when the company's worth practically nothing.
You got it. Then, when the company explodes in value and they sell, those millions are taxed as long-term capital gains.
Which is a significantly lower rate.
Precisely. They are legally restructuring how their wealth is categorized. They aren't just high-income employees anymore.
They're strategic investors. I mean, I get the upside, but man, I struggle to see how this is universally a smart move.
How so?
Well, an NFL player, for example, has an average career of just 3.5 years. Trading guaranteed right now cash for startup equity. When we know most startups fail, that seems incredibly reckless when your earning window is that brief.
You've hit on the exact vulnerability the financial guides warn about. It is incredibly risky, mostly due to what the industry calls the ego trap.
The ego trap.
Yeah, because elite athletes dominate physically on the field, they often fall into this psychological trap of assuming that dominance automatically translates to business acumen. So they skip the due diligence.
And if the company goes under, they don't just lose their investment, their brand goes down with the ship.
Exactly. We saw this vividly with Tom Brady and the collapse of the crypto exchange FTX.
Oh, we're right. That was a mess.
A total disaster. He tied his personal brand's gravity to that company. When it failed, the reputational contagion was just catastrophic. His image validated a deeply flawed platform, leading to severe public backlash and, class action lawsuits.
So if the risks are that high, athletes can't just cross their fingers and hope a startup survives. They have to actively engineer its success.
Which is why we are seeing athletes evolve into their own media networks to protect themselves. Look at LeBron James.
Right. He walked away from a guaranteed $15 million a year contract with McDonald's to back a smaller startup, Blaze Pizza.
But instead of filming a traditional commercial, he used his massive social media following to spark viral growth directly.
He cuts out the middleman entirely.
In academic terms, that's digital disintermediation. But practically, it just means the athlete is the media channel. and they're building the infrastructure to support it.
Like Kevin Durant's 35V family office or LeBron's LRMR Ventures.
Yes, these aren't just athletes and their buddies reviewing contracts. These are institutionalized venture capital firms managing a closed-loop system.
The athlete invests, promotes to their massive audience, and basically guarantees their own equity rewards.
Exactly. It's brilliant.
Bringing this back to you listening, you might not have an arena full of fans, but the core principle still applies. Are you just trading your time and skills for a simple paycheck, renting out your talent, or are you finding ways to build equity and ownership in your career?
It's the ultimate shift from extracting immediate value to creating long-term value.
It really is. And it makes you wonder about the future of the sports industry itself. Look at Lionel Messi. He recently secured unprecedented revenue sharing and equity options just to join Major League Soccer.
A total game changer.
Right. It leaves us with a fascinating question to chew on. What happens to the entire power dynamic of sports when an individual athlete's brand and financial infrastructure become larger than the league they play for? Something to think about.